who is attending. Definitely a big thank you for the Emirates Angels Association for organizing this session. Of course, the Emirates Angels Association has really been playing a critical role in terms of connecting different stakeholders of the ecosystem, catalyzing the VC ecosystem, educating the market over here and all the participants. So again, big thank you for Emirates Angels Association. And we have an opportunity right now to discuss an asset class that we've been passionate about, for years. And the way we have thought about structuring this presentation in order to make it an engaging presentation is basically I will be moderating between my partners over here. So you've got from the YAS side, Satyam Regmi, and of course, Ron Daniel, our partner from the liquidity group side. And we will be able to take you step by step into basically demystifying the asset class, let's say. It has been, spoken about in the region, and people are getting excited about it. So we will basically go section by section and basically make it a fun exercise. To start with, maybe I will say a few things about YAS Investments and basically how the story came about in terms of us creating this partnership. So basically, YAS Investment is an investment platform with two verticals. We have got a funds vertical that we've been operating a VC fund out of, but we also have an advisory vertical. And a couple of years ago, we at YAS have started to invest our own capital in the venture debt asset class while we have been managing Spartech Ventures and looking at the MENA ecosystem as it has been growing in a very exciting way. And before executing on setting up the fund, we were very fortunate to meet our now partners, Liquidity Capital. So I'll hand it to Ron, the CEO and founder of Liquidity Group, to say a few things about liquidity.
Sure, thank you very much, Agub. First of all, thank you for taking the time today, gentlemen. My name is Ron Daniel. I'm the founder and CEO of Liquidity Group. A few words about Liquidity. Liquidity has been founded at 2017 by myself, Meitav Dash. It's the largest institutional investment house in Israel, MUFG, the Japanese bank, second largest bank in the world. And recently we had Apollo, which is the largest alternative lenders in the world, joining Liquidity as a partner as well. Today we basically operating in two different spaces that are comprehensive to each other. At one hand, we are a very deep machine learning technology company that developed really disrupting and revolutionizing due diligence platform to generate on-the-fly due diligence for private company. And the second division is basically the AUM division that we use our own technology to deploy capital through venture debt almost globally. We work today anywhere from Australia, APAC area, Europe, and United States. And these days we are together with our partner at YAS, we are targeting MENA region. We opening a new office in Abu Dhabi next month actually. And we see a lot of demand. We're really excited about that. We just closed the first venture debt deal in the region with a company called Tracker about a couple of weeks ago. We see a lot of wonderful companies coming from Saudi Arabia, from UAE, from Egypt, and we're eager to bring our message into these areas as well. Number-wise, Liquidity has deployed about $1 billion in 2021 in about 80 different transactions. Our average ticket is 15 million, but it can vary from $2 million to $100 million per company. It's all a case by case, of course. We're targeting low mid teens IRR. So in 2021, we deployed about $1 billion at average of 13% APR, which is considered to be quite competitive in this segment. And we hope to keep the same pricing, same strategy, and same service in MENA, of course.
Of course, it's a great pleasure to have a partnership with Liquidity Group as basically integrating an already tried and tested product and service, basically to address the asset class to ensure seamless execution here in MENA. But before we go deeper in the topic, I guess a definition is due. Just a simple definition. Simply, what is venture debt? What's the fuss all about? How is it different between VC investing? How is it different than traditional debt? So, Sach, maybe you can help us out understand that a little bit.
Sure. Thank you, Yaqub. So broadly speaking, venture debt is specialty financing that is provided to high growth companies. Typically, these are companies that are that have raised Series A, Series B, and are in a very fast growing trajectory. However, they are not unable to tap into the traditional lenders such as banks due to the inability of those traditional banks to properly assess viability of investments in such high growth tech companies. So as a venture debt provider, what we look for is companies that are, that have some sort of technological IP around, that are showing of solid growth and are looking to raise alternative method of financing, not equity, but in debt form, in order to be it, fund their working capital requirements, to extend runway, in certain cases, even, raise funds to fund their capital expenditures, and so on and so forth. So this is broadly what venture debt is. History-wise, if you talk about it, it's been an asset class in existence since the 80s in the US, and gradually it has grown and expanded across the world. It's seen as a viable form of capital in the US, in Europe, in APAC, where Liquidity actually operates, as well as India and China. And in MENA region, it's something that has not been seen, and this is something that we are bringing here.
Of course, while we go through the presentation, we will touch on different components of venture debt and different parts in a little bit more depth. And as you can see here in this slide, conventional lenders, as Sach has been saying, need those stable, mature companies to be able to lend them with those, let's say, products that they can scale and understand. They need those assets. So it's quite a very mysterious asset class to traditional lenders. And as Sach has illustrated, it's been around for a long time, since the 80s, and it's basically an essential part of the VC ecosystem and any ecosystem. Now I go back to you, Ron. You're a serial entrepreneur. You're a founder. You've worked in different geographies in the US. How has the ecosystem, or how has the asset class evolved through the years, and why did you think there is a gap that you need to disrupt over there?
Sure. So when venture debt been introduced early 80s, it was basically a loss leader vehicle for commercial banks to generate and try to attract banking activities of fast-growing companies into their own commercial bank activities. The meaning was that although banks do not understand how to lend capital in a model which doesn't fit loan to value indicator, some bank in the United States, led by Silicon Valley Bank, by the way, decided that it's a good thing to track companies that generate, let's say, B round or C round, and immediately together with the round, lend them similar amount to the amount of the round, assuming those companies will deposit the capital and start managing their activity in this bank. So basically the security was the equity fund against the loan, and that's basically how venture debt has been operated in the first 30 years of venture debt, all the way to 2010, 2011. The meaning of this is that most venture loans basically lend companies their own capital. It was not so scalable. There was a very low glass ceiling. It still gave good companies to generate some cash flow, an extended runway, but very limited, and definitely not designed for scale, not the type of scale we see today. The big boom in this industry happened around 2011, where more and more alternative lenders started to inject capital into venture debt. And in the beginning, it was a combination of MES and other vehicles, but at the end of the day, it was type of venture debt. And slowly but surely, we're able to deploy capital not against the actual equity capital the company holds, but against other assets like IP value and cash flow. But in 2015, 2016, the market went through a serious change because, as we can see right now, the company's valuation and the working capital needs of the tier one tech companies exceeding any type of charges and securities these companies can provide against the amount of working capital they need. But on the other side, valuation is so high, it doesn't make sense to do an equity round, right? Because you don't want to dilute your company a year or 2 year prior to IPO or M&A event just in order to be able to sustain exponential growth. So venture debt has to be changed again. This is where liquidity got into the picture. We are today the world leader in this segment. And the reason is we are not lending against the assets, we are lending against our ability to know what's going to happen in the company prior it happening. We have a predictive system that basically generates over 95% prediction on the revenue and cash flow 24 months ahead and give us alerts every time something is about to change. So the ability to lend against future scenarios and to track these scenarios and to get cure if you have a certain risk level that suggests this scenario might happen, enabled venture debt to exceed the loan to value ratio, which is the traditional type of lending, and basically better fit companies that generate over 30% growth year over year. And usually that goes together with negative cash flow. Now, tech is not real estate. Tech is not that most tech companies just don't have any strong asset to secure against the loan. So the only way to provide capital to these companies is to really understand those companies in real time better than the companies sometimes understand themselves, and to bypass all this subjective bias of a company regarding to its own nature and execution. And so this is a little bit about the history of venture debt and how it is where it is today. I think the ability to break the glass ceiling between the loan to value or traditional ratio to something else, basically make it almost unlimited in the amount of capital that can be deployed in a defined risk level. So you can redefine the risk level and price reward ratio that you're seeking to get as a lender. And if you have enough technology and enough ability and enough visibility into these companies, the amount of capital that can be deployed is almost endless. There's no glass ceiling to it. That's what enabled the companies to, reach higher and higher valuation and push the time frame between rounds from traditionally 12 to 18 months to sometimes 24, 46, and sometimes without any round at all, if the company can generate enough money and cash flow to support the interest cost.
Of course, we will touch on the benefits, the various benefits of venture debt, whether from an investor's perspective or a founder's perspective, and how VCs and venture debt providers usually work hand in hand. And there's always a win-win scenario that is achieved in these things. But I have to add in from my side how, we honestly do feel excited about, bringing this disruptive technology to the asset class. I mean, traditional venture debt lenders do a lot of, kind of manual work that we still do, like timing when the investment is done, looking at, the cap table, looking at the quality of the VCs available in the cap table. And those are all components that are very essential to ensure managing the risk when deploying in the asset class. But just by the ability of being able to add a disruptive software and gain that visibility ahead is really, really exciting. So Ron, if you can tell us about your global experience. I mean, you've been investing in the US, you've been investing in Southeast Asia, you've been investing all over the place. So if you can give us a taste of some of the partnerships you have, what value they perceive in this technology and the software, which will give our viewers an idea about moving from manual or supplementing the manual and adding that tech layer that just basically, manages the risk in a way that hasn't been done before.
Yeah, sure. So I think reputation-wise, tech industry, and especially venture capital industry, has been suffered a lot from what we call statistic doesn't lie, but liars use statistics. And not without a reason. I think what we see a lot in the tech industry, it's a lot of manipulation about statistics, right? And at the end of the day, the ability to really understand a potential borrower and to track a potential borrower is the ability to bypass all these statistical measurement and to be relied on financial reports or a company's report. Now, the ability to go directly to the raw data, this is the key. If you are able to go directly to the raw data of these companies, and most of it is completely available through APIs, because most of these companies working with online accounting system, they are connected to banks, etc. So the ability to collect the raw data from these companies on a real-time basis, enable to generate a very good picture of what's going on under the hood of the company, how customer acquisition really looks like, what lifetime value really means, what unique economics looks like, what is the trend, does the churn fit the vertical or not? And I think most of the lenders in the world, when they think venture debt, they're really afraid they don't understand the data or don't trust the data. And the moment you break this equation of untrustable data or subjective data, let's call it, then sky is the limit, right? Because you can really understand, is it a good company or not? Now, defining what is a good company, it's a completely different question. We can answer it later if we have time. It's a long answer. But in high level, a good company is a company that you can see basically the few things. You can see the unique economic is positive, meaning you earn more from a client than what it cost you in relatively fast, so you don't have to carry too much negative cash flow. Second, the negative cash flow is being generated in a company not because the company subsidized its client, but because it generates a lot of growth in new clients. The churn rate is very low or even negative, so you can accumulate clients over time and revenues. And the customer acquisition cost is stable over time, meaning it doesn't cost you more to bring additional clients over time as you grow the business. If you can detect those parameters in a company, you know roughly you have a good company you want to dive into. After that, it's a whole different story of how you understand which one of them is better, which one is fit for venture debt. but this is the, let's say, the first stage you have to go through. I'm not sure if it's answering your question, but
it does, Ron. It does, and I want to move to also another topic with you before I move back to Sach and ask him a question, which is, we all know that founders really need to time their capital raises right. They really need to understand when to basically go for the venture debt option. Time it maybe with the capital raise. I mean, whatever reason the founder will have. And as we know, and this manual process of assessing the risk of a startup, doing the due diligence, usually takes time. Can you tell us a little bit about your underwriting process at Liquidity, how you've been doing it globally, and how we will want to replicate that in the region?
Sure. So basically, liquidity analysis is basically a US patent methodology. We've been granted a US patent on the whole platform about 3 months ago, after 4 years. It's a very vast patent that basically defined the whole process of due diligence as one unit. What we do is every company that applies for funding go through a 10-minute process of integrating its data sources through the APIs. And the moment the databases are available to our system, the system basically generated a 4-step due diligence process. First of all, it's a descriptive part. We benchmark 100 and different parameters, what we call sensors, against the company class, whether it's a SaaS company, a B2C company, whatever company it is. The system recognizes the patterns and basically classify the company according to similar classes, and benchmark this specific company against the anchor modeling of the entire market, which is over 40,000 different anchor companies in the model. And the company is getting score for every important parameter. As I said, from unique economic to churn, to quick ratio, to whatever parameter you can imagine on the company is being scored against similar company in similar classes, and then produce aggregated score from 200 to 800, very similar to FICO score, just for private tech companies. We only continue to next step with companies that are beyond 520, which represent they are better than the median in their own class. Okay. The next step is the predictive step. The system basically trying to check, and we have sets of algorithms that check that. What are the potential growth patterns that this company can go through, and what is the probability for each of these scenarios to happen? Okay. Then the system generate a correlation breaks and anomaly breaks. The system analyze what type of correlation there are between the different parameters of in the company. So, for example, how would customer acquisition cost will influence churn, will influence top line revenue, will influence cash flow, and look for these patterns. And the system basically alerts against potential breaks in the correlations. Okay, this is something a human eye cannot see 99% of the time. And assuming all those correlation breaks been mitigated properly, then a human analyst get involved in the process and generate, using a simulator, different deal scenarios, and the system shows him what deal scenario is basically optimal for this specific company, meaning how this company gonna use this capital for growth, and which scenario generate the best cash flow scenario for the company to support the debt and the growth without adding additional layers of risk to our capital. This is an ongoing process. So the immediate process takes like 20 minutes to fully understand and due diligence a company. The system does it really, really quick. But then, since the data sources are remained integrated through the whole period of the facility, the system keep on tracking and search for breaks and keep on scoring the company every month. So we can see ahead of time if something happens, right? If the company finds, if the platform finds a break in one of the correlation, it immediately alerts and shows the analyst exactly where the break is about to happen. And then the analyst has to mitigate this risk with the company. Assuming you get a reasonable response, the deal can go on. If not, this is we can declare a market event, and then we can basically recover the investment before the event even happens.
I mean, this is really exciting. Really, I mean, we've been experimenting before our partnership with the Liquidity Group on the asset class, and we've met a lot of startups in the MENA ecosystem while we were investing from Spartak Ventures. And I can say confidently, timing is key. It's very critical. Founders need that visibility. VCs need that visibility in terms of yes, no, and execution and term sheets. And, it's really nice to see basically a disruptive software enabling the shortcut for that. So I will move to you, Sach.
But also, Yagub, today, most of our portfolio, the board of those companies in our portfolio approach us to really know what happened in the companies. So I believe we have many investors here in between the people who join. I can quite feel comfortable when saying that your own understanding of the company you are invested in is partial. In a board, you always hear the side of the story the company see, and it's not a fraud or anything. It's just a perspective. And most of the board members don't really have a real-time objective perspective. They're approaching us to get this type of perspective.
That is really disruptive. And a big question now, is the MENA ecosystem ready? We've been, as I said, active in the asset class. We heard a lot of, questions like that. Is the MENA ecosystem ready for venture debt? Sach, we've spoken about that previously. Why don't you let us know what your perspective is on that?
Sure. Thanks, Yagub. Yeah, I mean, when you talk about MENA ecosystem, the VC ecosystem specifically, it has grown and evolved significantly in the past few years. So when we talk about growth, there's been growth both in terms of total fundraised. I think in 2020, it was about 2 billion, up 100% from 2019, where it was only $1 billion plus. There's also growth in terms of the check sizes that's been written, in terms of deal value, as well as in terms of total VC firms that are operating in the region. Then there's a significant evolution as well. And when I say evolution, it primarily focuses more on the quality of the startups, the kind of problems they're trying to solve, the quality of the founders, and the general sophistication that the ecosystem has seen in the past few years. And this sophistication is quite very much reflected in the fact that a lot of startups and a lot of venture funds are realizing that there should be an alternate solution for fundraising, especially when they're seeking to perhaps grow the company in terms of acquiring certain capex machinery, or in terms of managing the cash flow, working capital, so on and so forth. So with that sort of sophistication, we have been seeing quite a lot of companies in the region seeking venture debt. There are some examples on the screens that you can see. As Ron mentioned, Trucker is something that we are currently investing in. The deal should be officially announced soon. There's Tribal, Pure Harvest, so on and so forth. So typically, a few years back, you had companies that relied primarily on equity, but now with the option of venture debt, the companies have alternative ways to grow their company, grow their businesses without necessarily diluting themselves. So all in all, we are seeing quite a lot of big opportunity in the market, given the size, given the fast pace of the market, and given the sophistication of the startups, as well as just the general ecosystem.
And I would like to add 2 points to that, to the wise things that such as said, two additional trends that I think we can detect from our experience so far is that traditionally the MENA market was developing inbound solutions. So usually it was some kind of a solution that was existed globally and being designed and produced specifically for the MENA region, because the MENA region is quite a large region with a lot of population, so it's a big market. So most of the solutions were directed into the market. What we see now with companies like Sari, for example, a Saudi Arabia company, is that innovation that goes globally beyond the MENA region is starting to emerge inside the MENA region, which is, first of all, amazing to see and really encouraging. And second, that means that down the road, this type of companies will need a lot of cash on a working capital form in order to expand their activity globally beyond the MENA region. Another trend that I think we can point out is the fact that many global companies, startups, are starting to move a lot of their activity into the UAE, especially inside the MENA, the UAE, and develop R&D centers and develop sales activity. And that means that this type of companies, they don't just see, cost-effective facilities, the ability to import employees from all over the world, friendly regulation and bureaucracy. They also will consider to finance their business in this market and not in their original market. That will also increase the demand in this market. I can tell you that only from Tel Aviv, there are 4 companies I know, including Liquidity, by the way. Liquidity opened an R&D center in Abu Dhabi lately, but many other good companies like eToro, which are our client, Wix, which is a public company, a huge startup, Monday, they are planning on opening R&D center in Abu Dhabi. That means that they will bring the financing in demand also from this region. And all this, it's piling up.
I think it's basically a very symbiotic relationship, right, between venture debt, VC, the ecosystem as a whole, the growth of the ecosystem, and to me, it feels like a perfect timing to include the asset class. It's definitely in need. And maybe for the sake of the audience, we've got audiences from all around. We want to just maybe take a step back and understand those benefits. I mean, what are the benefits for the founders? Let's have it in numbers. Let's have that perspective. I mean, why will founders pay a certain pricing? Why would they take debt? Why wouldn't they just raise equity? Maybe Sach, if you can help us out with that.
Yeah. So, I mean, in terms of, look, purely from a mathematical perspective, if your startup is growing at 2x, 3x a year, you're seeing that much sort of increase in your value of your company and value of your equity. It becomes significantly cheaper for you to perhaps tap into venture debt where you're not diluted, and where instead of giving up that 2x, 3x on your equity, you're giving, say, something in mid-teens in those venture debt coupons. When you do the math on a long run as well as in the short term with high growth, it makes more sense to tap into venture debt where you're paying something lower than what you pay for equity, and you still retain the ownership in the company. In general, when we talk about the interest rate as well, venture debt interest rate on venture debt falls somewhere between what you have the rates for this mid-market rates and somewhere between what the equity returns would be. So for an astute founder, it always makes sense. It makes sense typically to balance their cap table or balance their balance their capital in certain ratio with debt and equity in order for them to fund the company in a proper manner without necessarily having to give away excessive dilution as well as paying high price for equity. I hope that answers your question, or is there anything specific you wanted to?
No, of course, it definitely does. I mean, at the end of the day, if you look at kind of how a startup, a life cycle is basically, there is a seed round at the beginning, maybe an angel round. They develop their product. They got to a point where there is product market fit. At that point, in between rounds, it would be definitely very advantageous to buy an extra 9 months, an extra 6 months, achieve those revenues, take those market shares, rather than to go prematurely and raise an equity round. This way, the founder definitely is not diluted. The VC investors are not diluted, and basically the runway just extends for this startup. And this is from a startup perspective. I just want to ask you, Ron. I mean, you've funded some unicorns. You've seen how they act, and hopefully the region over here will be seeing more and more unicorns. But from your perspective, what has this experience been like in terms of accessing venture debt, as a facility?
So we see an interesting trend. Lately, as you all know, equity became very cheap. So we have some global giant like SoftBank and Tiger, and they just distributing huge check everywhere, providing high valuation. This is a dangerous move for many of the companies, for small companies. If I was the entrepreneur, I would take the capital, but this is a very dangerous capital to just take and consume. This is a capital you need to take as a safety zone, because if you price the company too high, I give you an example. There is an Israeli company. They got a $300 million for $6 billion valuation. The company has $15 million of sales. Okay, it's a 2-year-old company. That's crazy, right? There's nothing that can justify the valuation beyond the fact that those private equity developed a new strategy that says, let's pull a lot of money to be able to attract the best employees, and we'll figure it out. But what if you don't figure it out? All right. So a lot of cash on the equity form can be very dangerous for the company DNA and for future rounds, because if you raise in a high valuation right now, you have to justify it in sales at the end of the day. You have to make the next round even higher, significantly higher. And not always there's someone like Tiger on the door that's willing to put any type of valuation as long as he controls the deal. And so the ability to generate an hybrid deals between, valuation that serves the story, because valuation of a company until it goes public, to be honest, is just a story. A good startup understands that in order to become public one day or get a good M&A or becoming an independent company, you have to build up a valuation in a steady trend. You cannot go up and down just because you didn't achieve the last one. You don't have a second chance here. And the ability to generate this hybrid model that you raise 50% or 60% in equity in a reasonable valuation, right? Because the amount of capital also suggests what the valuation is. You will not raise $20 million at $1 billion valuation. You will raise at $200 million, right? Because the new investor wants to hold at least 10% of the company. So the amount you raise suggests what the valuation is going to look like. And so the ability to generate both, let's say a company needs 40 million, and you know the right valuation is 200, 300 million, it can generate the right combination to get to this point without harming the future story of the company. Because to take now money in too high valuation, it's easy these days, but we have a sentence saying you have to stand behind what the valuation you got. If you are not standing behind the valuation, this is a short-term story. After that, it was going to be ratchets and down round, and it's a very aggressive story, which most company cannot recover from. So I think in a weird turn of event, venture that became a vehicle that enable entrepreneur be less aggressive and achieve better results.
And look, I mean, responsibility in terms of not exceeding, debt capacity, right? I mean, usually, you see companies raising 20% of the equity round, 25% of the equity round, also on a venture debt facility, and it has to be used responsibly. I just got a note from the organizers. I just want to remind everyone, if you have any questions, please post them on the chat. In the presentation, because there will not be a live Q&A other than the questions. We'll be definitely happy to answer them in a little bit. So that's really interesting. I think let's go a little bit more granular.
I think there are. I just looked at the chat and I see some questions. So maybe we want to take a minute to have a look.
See. Ron, I suggest, cover just the structure. I think a lot of people don't understand what the structure of a venture debt facility is. The interest component, the warrant component, and how usually it is priced. So maybe just for the benefit of the listeners, just to learn a little bit more about the asset class and how to manage the risk. Maybe Sach, you can tell us a little bit about that while I sift through the questions.
Sure. Thanks, Yagub. And Ron, please feel free to step in as well. So typically, a venture debt package, would consist of a tenor. Typically on our side, it's a 3 months tenor, 3 years tenor, sorry, with a certain amount of initial grace period. The loan amounts, as Ron mentioned earlier, in our case in particular, it's anywhere between 2 to 100 million. For Yas liquidity, it's anywhere between 1 to 20 million. Interest rates, as mentioned earlier, it's a premium above what you get for small and mid-market interest rates. And there's usually a small equity warrant attached to that, which is, again, it depends on a company by company, case by case basis. But the warrants are attached to it. It can either result in a cashless settlement or a cash settlement at the end of the tenor. Typically, when and if applicable, on a sort of global basis, there could be some sort of additional covenants and some sort of guarantees or asset backing attached to it. But in liquidity's case, that's slightly different. So this more or less is the structure. You've got the tenor, you've got interest rates, you've got any sort of warrants, plus any sort of backing through assets or backing through IP.
Interesting. Thank you, Sach. I'm looking at the questions right here, and we've got a question from Othman, and he's saying, we see here some examples of companies that raise venture debt as Series A and B. Is it possible to raise debt at an earlier stage? I think
maybe I'll take it. Yeah.
Go ahead,
so Othman, first of all, good question. Most of the companies that you see here are actually post-C round. Okay. Theoretically, you can. The answer is yes. You can take venture debt at almost any stage. The question is what type of venture debt you're gonna take. Usually at very early stage, but has to be post at least one investment in the company. Some banks will provide you a small venture debt loan against this capital. So it's not a highly recommended procedure to go through, and not a particularly recommended result. Best point of time for a company to take venture debt is the point that the company can prove the unique economic of its model. What does it mean? It means that you can say, hey, I developed a product and I have this initial point of proof of concept that this product has a good product market fit. I see the demand and I managed to generate some sales that demonstrate how much it's going to cost me to bring another client and what revenues I'm going to generate from this client. And hey, by the way, this is the size of the market. So if I get more capital, I can buy more of the market, more clients. This is the optimal point in time to take debt, because this is where the lender feels secure that you know what you're doing, right? And if you know what you're doing, there is less chance you're going to lose the money or will not be able to pay back. Confidence is very important when it comes to pricing and to risk assessment. So you have to be at the point that you can prove that you understand the mechanics of your business model of the business. And usually this is when a company reaches revenues of at least $3 million a year run rate. And this is the recommended time. I wouldn't recommend you to go earlier than that to take debt, because debt eventually you have to pay back at some point.
And maybe a general point to add in here as well, and then we can go specifically to the qualifying criteria for YAS liquidity. But generally speaking, venture debt players would like to see quality VCs on the cap table. It is, it is very important for founders to basically ensure what type of money is coming in, because at the end of the day, there is a relationship that develops between the venture debt provider and the VCs on board. And then the VCs have an inherent interest, basically, to follow on those investments. So if you have all these components correctly, as Ron here stated, product market fit, a certain maturity and ability to take on that facility, having a great cap table definitely helps. But I'll ask you, Ron and such, what are the qualifying criteria for YAS liquidity partners, since the question came up?
So very straightforward. We are providing capital to companies who reaches at least $2 million in annual sales, that can demonstrate 30% growth year over year in average, that are doing sales at least 1 year, okay, 12 months, and that the IP is technological, meaning the company is a startup, right? It's not just a commerce company, for example, it's an e-commerce company. It's not just a recurring revenue. It's a recurring revenue based on a software. So we need to have this technological element into the company that basically define, and it's defined by very simple. If the technology is the business enabler, that's a technology company, right? If the company can work without the technology, it's not a technology company.
That is, thank you so much, Ron. I'm looking at the questions again. And here is a question about basically interest plus debt paying back, and just a question about if kind of the structure could be compatible with basically an Islamic financing. The quick answer is definitely. We're basically exploring and looking into different structures. And if you think about it, venture debt at the end of the day is a bit of a arguably a safer mezz financing. So whatever kind of financing could be applied in a conventional way could also be looked into in an Islamic way. So this is to answer your question. I think it's Maymuna. Thank you so much for the great question. I want to touch on, as the questions are coming in, and I see the slide over here in terms of explaining the different components of the structure. Maybe how does pricing, how do we arrive to pricing? I think Sat, you touched on it a little bit, and it would be great to have perspective from both Ron and Sat on this one.
Sure. So eventually, like all financial products, pricing is a matter of strategy, and it's a matter of risk-reward ratio. There's supposed to be some type of a ratio between the risk the lender takes and the pricing of the loan. So, of course, we do the same. We do a due diligence process. It's a very quick process. We understand the company, and assuming the company, we're grading the risk from L1 to L10, which is basically very similar to A, B, C type of grading. So it's very similar to if the company is a B plus company, it's a different interest rate than if the company is triple C, right, or triple A. So according to the risk reward ratio that we find in the due diligence, meaning the more safe the company is, the lower the price. The price can change from anywhere between 9% to 25%. Depends on the company, on the stage, on the size, on the investors, on the trend, etc. Usually, most of our deals are ranging 10 to 12 to 13%.
And maybe also a reminder to the audience, sorry, that usually in venture debt, there are several components. There is the profit component on one hand, and this is a cash payment from the startup. And then usually there is a warrant attached basically to the structure as well. This links also, kind of the perspective of the venture debt provider usually as a balance between a long-term perspective and a short-term perspective, as well as being mindful of what the capacity and what makes sense for startups. At the end of the day, each deal is unique and basically needs to be looked at in a unique way. Sach, I see you wanting to add a few points over here, reading your body language.
Yes, yes, definitely. It's a very small part to add. And as Ron mentioned, like a lot of startups nowadays are global. They're trying to go global, and technology can pass across the borders. But however, with that, there's also a small element of geographic specificity. So, and this goes back to the function of what the prime rates in those particular geographies are. So, for example, if you were to look at US, the venture debt rates might be on a lower side because the cost of capital there is significantly cheaper than, say, somewhere in India, where the cost of capital is pretty expensive, and that basically factors in the, first of the currency fluctuation as well as the geographic risk. And as a function of that, the venture debt rate in India is, in high teens. In China, it's more or less kind of random. It ranges anywhere between 9 to 18%. So there's also an element of geographic specificity and geographic risk that comes into the factoring of what eventual debt package could look like.
I see, Ron. So we've got a signal from Jassim over here that we have an extra 7 minutes for questions. So this is what we're doing, Jassim. Thank you. And I see, Ron, you've answered the question over here, but maybe just to speak about it in terms of, I think, the qualifying, like the minimum annual revenue required, and which sectors do we focus on?
Sure. So as I wrote, the minimum is $2 million a year run rate. And we invest across all sector. We rarely do gaming related, and we don't do crypto, forex, all these type of industries. We do not touch it.
Okay, so here we got a question from Ma'an Samara. Is having a VC on the cap table mandatory for qualifying for YAS liquidity?
It doesn't have to be venture capital, but it can be any other type of institutional investor, but the answer is yes. I can explain the reasoning behind it. All our statistical regression anchoring models show that when there is one institutional investor in a company, the ability of a company, especially a relatively early stage, to survive hiccups significantly higher. When if a company is basically bootstrap without any investors or institutional investors of any type, it's very hard for the company to survive over time.
I have a question from Maymuna here. Maybe Maymuna, if you can clarify a little bit as well. So it says, can a startup also approach YAS liquidity to assess their future progression of the company they're invested in? If you can clarify, Maymuna, would be a pleasure to answer.
I think the question is very clear to me, at least. The answer is yes. We are happy to see more data of more companies, so we have an interest to do so. And it's an automated process. So we also share with the companies that approach with us our insights about what we found.
All right, I'm just getting questions now on my WhatsApp, and I'm getting questions on I think as we're approaching the end of the presentation, we'll try to dig out a question from here. But it would be definitely a pleasure to meet you one-on-one, answer your questions. You have our contact details over here stated in the presentation, and if not, definitely Emirates Angels Association would be basically ready to share those contact details. So apologies if we haven't got to your questions, which are really interesting and important. So there you go. You have an email for us to direct all questions, and we'll be happy to answer those. Sach, Ron, I think if there is anything that we would want to end with, or maybe if there is any question that I've missed mentioning, as I'm trying to focus on multiple things here.
Maybe can you hear me, guys?
Yes.
On my end, I just want to add two things. First is that we see that venture debt become a standard in the market, and most institutional investors have at least some percentage of their alternative lending portfolio in venture debt funds and activities. That's very encouraging. That means that there's a demand and there's origination for this asset class, and it will continue to grow, and it will provide better and better solution all the time. It's not perfect yet, but it's progressing. And second is a more personal note. I am very excited about our activity in MENA. For me personally, it's an amazing experience. The people that I meet, the amazing culture. It's just exciting, and I definitely looking forward to meet over time all of the people who participated here and beyond that. I'm coming to Dubai and to Abu Dhabi very often, usually at least once a month, excluding times when COVID doesn't allow. I'm going to be there tomorrow to the rest of the week. So if someone wants to meet, you can write us. We'd be happy to meet and explore opportunities together. I think what Yagub and Sach are doing is very innovative for the region, and I'm sure it will impact the market properly.
And it's been such a rewarding partnership, Ron, that we've been working together for a while now, approaching a year. So it's definitely exciting to bring the asset class to the region as we intend. And I would like to thank all listeners and joiners. I wish we had more time. There's a lot more we would want to discuss, but we aimed at touching, on a high level at different components. And as I said, demystifying the asset class. It's been a real pleasure. Thank you, Emirates Angels Association, for letting us speak about something we're passionate about and we believe in. And, looking forward to that cooperation and catalyzing basically the ecosystem here in MENA, which we have high belief in. So thank you very much. And again, hope to speak to you soon individually. Thank you so much.
Thank you very much, everyone.
Thank you very much, everyone.